In 2008, the U.S. housing market experienced a cataclysmic downturn, with home values plummeting by over 30% nationally, according to the S&P Case-Shiller Home Price Index. For investors caught in the crossfire, this period was not merely a market correction, it was a crucible. Many faced immediate financial ruin, their carefully planned projects collapsing under the weight of evaporating equity and frozen credit markets. But what if you could not only survive such an unprecedented crisis, but emerge stronger with a refined strategy and an unshakable understanding of tangible asset management? We will explore precisely that through the extraordinary journey of Sarah Chen, an investor whose ambitious house flip project in 2008 became a high-stakes lesson in resilience and strategic adaptation. Sarah Chen, a seasoned real estate investor with a portfolio built on strategic acquisitions, had always prided herself on her meticulous due diligence. Her latest project, a charming but dilapidated Victorian in a burgeoning neighborhood, promised a substantial return. The initial pro forma projected a 25% return on investment, or ROI, which is the profit generated from an investment relative to its cost, after an estimated 6-month renovation and sale cycle. This property, acquired in early 2008, was intended to be a textbook example of a successful house flip, a strategy involving purchasing, renovating, and quickly reselling a property for profit. However, the global financial crisis rapidly reshaped the economic landscape. As Sarah's renovation neared completion, the housing market began its precipitous decline. Buyer interest, once robust, evaporated almost overnight. The once promising neighborhood, fueled by easy credit, suddenly seemed stagnant. This dramatic shift created an acute investor dilemma: proceed with a sale into a falling market, almost certainly at a loss, or devise an entirely new strategy. The initial investment, substantial even for an experienced investor like Sarah, now represented a significant portion of her liquid capital, placing immense pressure on her entire financial standing. Compounding the market's volatility were unforeseen structural issues that emerged during the renovation. A routine inspection revealed extensive termite damage in the subflooring and a compromised foundation, necessitating an additional $45,000 in repairs beyond the allocated budget. This unexpected expenditure drastically inflated the project's total cost, pushing it dangerously close to the projected after-repair value, or ARV, which is what the property is expected to be worth once all renovations are complete. The margin for profit, already razor-thin due to the market downturn, now threatened to disappear entirely, transforming a potential gain into a guaranteed loss. The financial implications of these combined factors were dire. Sarah found herself staring down the barrel of potential financial ruin. Her construction loan, a short-term, high-interest instrument designed for quick flips, was rapidly approaching its maturity date. The interest payments alone were a significant drain, and without a buyer, she faced default. This was not merely a setback, it was an existential threat to her investment career, demanding an immediate and radical shift in strategy. The pressure was immense, requiring not just financial acumen, but profound psychological fortitude. Sarah's first strategic pivot was a profound reevaluation of the property's highest and best use. The quick flip was no longer viable. Instead, she began exploring the possibility of converting the property into a rental asset. This required a complete overhaul of her financial projections and a deep dive into the rental market dynamics of the area. Could the property generate sufficient rental income to cover its carrying costs and eventually yield a positive cash-on-cash return, which measures the annual before-tax cash flow against the total cash invested? This question became her immediate focus. To bridge the immediate liquidity gap and service the maturing construction loan, Sarah explored creative financing solutions. Traditional bank loans were scarce and difficult to obtain for non-owner-occupied properties in that climate. She turned to private lenders, offering a higher interest rate in exchange for speed and flexibility. Simultaneously, she investigated seller financing options, though finding a seller willing to carry a note in such a volatile market was challenging. This period underscored the critical importance of a diverse network and an open mind to unconventional capital sources. Understanding the financial viability of a rental conversion demanded a precise calculation of the property's cap rate or capitalization rate. This metric, defined as the net operating income, or NOI, divided by the property's current market value, provides a quick snapshot of a property's potential rate of return. A higher cap rate generally indicates a more attractive investment. Sarah meticulously projected the NOI by factoring in potential rental income, property taxes, insurance, and maintenance costs. Her analysis also included the debt service coverage ratio, or DSCR, which measures a property's ability to cover its mortgage payments, calculated by dividing the net operating income by the total annual debt service. Lenders typically prefer a DSCR of 1.25 or higher. The decision to lease was a calculated risk. It meant transitioning from a short-term capital gain strategy to a long-term income-generating asset. Sarah adjusted her renovation plans, focusing on durability and tenant appeal rather than high-end finishes for a quick sale. She implemented a rigorous tenant screening process, understanding that reliable rental income was paramount to stabilizing her investment. The property, once destined for a rapid turnover, now became a pivotal component of her long-term wealth strategy, providing immediate cash flow to mitigate the market's impact. While the property was generating rental income, Sarah closely monitored the broader market recovery. She understood that timing the eventual sale would be crucial. Experts at the National Association of Realtors suggested that property values would likely stabilize and begin a gradual ascent within 3 to 5 years post-crisis. This long-term outlook allowed Sarah to breathe, shifting her focus from immediate distress to patient strategic positioning. She began to view the property not as a failed flip, but as a strategically acquired asset that she was holding through a down cycle. The renovation adjustments were critical to managing costs during this extended holding period. Instead of completing all high-cost aesthetic upgrades at once, Sarah implemented a phased approach. Essential structural repairs and critical system updates, such as HVAC and plumbing, were prioritized. Cosmetic enhancements, like premium countertops or designer fixtures, were deferred to be potentially completed closer to a future sale date when market conditions improved and justified the additional investment. This fiscal discipline prevented further capital drain and preserved her ability to service the debt. Moreover, Sarah began to consider the long-term tax implications of her holding strategy. She became acutely aware of the potential for a 1031 exchange, a powerful IRS provision allowing investors to defer capital gains taxes when selling an investment property and reinvesting the proceeds into a similar property. This foresight allowed her to structure her eventual exit strategy with tax efficiency in mind, a crucial element for maximizing net returns in real estate. Understanding these legal and tax frameworks provided a roadmap for future wealth preservation. Beyond financial mechanics, Sarah recognized the immense value of her professional network during this period of crisis. She leaned on her real estate attorney for guidance on potential legal ramifications, consulted with experienced property managers to optimize rental operations, and sought advice from mentors who had navigated previous market downturns. This collaborative approach transformed a solitary struggle into a collective effort, reinforcing the investor mindset that successful real estate ventures are rarely undertaken in isolation. Building a robust support system proved invaluable for both strategic insight and emotional resilience. As the market slowly began to recover, Sarah meticulously tracked key indicators: local employment rates, population growth, and housing inventory levels. Data from sources like the U.S. Census Bureau and local MLS listings informed her decision-making. She sought out leading economic forecasts, using them to project future appreciation trends. This data-driven approach ensured that her eventual decision to sell would be based on objective market signals rather than speculative hope, distinguishing her from many investors who reacted emotionally to the crisis. By 2013, the housing market had shown significant signs of recovery. Property values in Sarah's neighborhood had not only stabilized, but were beginning to appreciate steadily. The demand for well-maintained homes was returning. Her rental property, having generated consistent income for several years, was now worth considerably more than its initial purchase price, plus renovation costs. The patient strategy had paid off, transforming a desperate holding action into a profitable long-term investment. Executing the sale in 2013 required careful timing and effective marketing. Sarah leveraged the property's positive cash flow history and its fully updated core systems, a testament to her earlier renovation choices. The property sold for a substantial profit, yielding a remarkable 35% ROI over the entire 5-year holding period, far exceeding her initial pre-crash projections for a 6-month flip. This successful exit not only validated her strategic decisions, but also provided a significant capital injection for her next ventures. The lessons Sarah Chen learned from her 2008 house flip project were profound and enduring. The experience instilled in her an even greater appreciation for risk mitigation, the power of adaptive strategies, and the critical importance of a diversified investment portfolio. She understood that market cycles are inevitable, but an investor's ability to pivot, innovate with creative financing, and maintain a long-term perspective can transform potential disaster into significant gain. Her story serves as a powerful reminder that resilience and strategic foresight are paramount in the dynamic world of real estate. For aspiring and current real estate investors, Sarah's journey offers invaluable insights. It underscores the necessity of robust financial modeling, the exploration of alternative financing avenues when traditional routes close, and the strategic flexibility to convert a property's purpose from a flip to a long-term rental, or vice versa, based on prevailing market conditions. Maintaining a healthy cash-on-cash return and a strong DSCR are not just theoretical exercises. They are vital safeguards against market volatility, ensuring your assets can weather any economic storm. Ultimately, Sarah Chen's rescue of her 2008 house flip project is a testament to the enduring power of tangible assets when managed with intelligence and resolve. It illustrates that even in the face of unprecedented challenges, calculated risks, informed decisions, and a commitment to continuous learning can pave the way to substantial wealth creation. The market will always present its trials, but with the right strategies, investors can navigate them, turning adversity into opportunity and building a legacy of financial independence.